basis, and the other way is called the accrual basis. And actually, only one of these ways is allowed by GAAP. If you're trying to follow GAAP, then you are required to use the accrual basis. But many small businesses are not required to follow GAAP. They're not publicly held, and if their bank doesn't require them to follow GAAP or anybody like that, then they may not follow GAAP, and the cash basis they may find to be simpler. Another reason they may follow the cash basis is if they're a small business, they may file their income tax returns on a cash basis, and it makes it simpler if they prepare their books on the same basis as their tax returns. Larger businesses, though, are required to prepare their tax returns on an accrual basis anyway, so they might as well follow GAAP, prepare their books on an accrual basis, and prepare their tax returns on an accrual basis. If a business uses the cash basis of accounting, then revenues are recorded when cash is received, and expenses are recorded when cash is paid. If they use the accrual basis, then revenues are recorded when they are earned, and expenses are recorded when they are incurred. It's not real obvious what we mean by that, but that will be, I think, clearer when we look at the examples that are given on the next couple of slides. Let's say we have a business that's a florist, and if we're using the accrual basis of accounting, when we deliver flowers to a customer, then we have earned our revenue. We've delivered the product, we've performed the service, therefore we can record the revenue from that sale. On the other hand, if we're using the cash basis of accounting, we don't do anything necessarily at the time that we've delivered the flowers. Instead, on a cash basis, what's important is when we receive the payment for the flowers. So we wait until we receive a check in the mail paying us for the flowers, and at that point, if we're on the cash basis, we would record the revenue on our books. Okay, let's say that one of the expenses we have as a florist is a water bill. If we're on an accrual basis of accounting, as soon as we receive a water bill in the mail, we record that on our books, even though we haven't paid it yet. And at that time, it becomes recognized as an expense. If we're on a cash basis, we don't do anything at the time that we receive the water bill in the mail. Instead, we wait until we actually pay the water bill by mailing off a check, and at that point in time, we would record an expense for the water bill when we pay it with cash. The matching principle governs when it is that we record an expense. It tells us that expenses are recorded in the period in which they are incurred. Thank you. And expenses are matched against the revenues of the same period. You may remember back in chapter 1, we said that expenses are incurred in order to generate revenues. So in whatever period you're recording the related revenues, that's the period where you want to record the expenses that were incurred in order to generate those revenues. Now, back in chapter 2, we talked about the trial balance. And that trial balance, now, instead of just plain calling it a trial balance, we're going to call it the unadjusted trial balance. because there'll be another trial balance that we will prepare later in this chapter that we'll call the adjusted trial balance. And we're going to use the trial balance to make adjusting journal entries. And the reason that we will do this is to make sure that our books are on an accrual basis at the end of the accounting period. So when we get to the end of the accounting period, we would scan everything that's on our unadjusted trial balance. And for example, I would look at the prepaid rent account, and it would occur to me that a month has gone by without any adjustment yet to that prepaid rent account, and yet we've used up a month's worth of that prepaid rent. So we're probably going to have to make an adjusting journal entry to reflect the fact that some of that prepaid rent has now been used up. The adjusting journal entries, as I was just suggesting, are to make sure that revenues are recorded in the period in which they are earned, and expenses are recorded in the period in which they occur. There are really 4 types of adjusting journal entries, and we'll look at one or more examples of each one of these 4 types of adjusting journal entries. 2 of the types are called deferrals. So a deferral is when you defer the recognition of revenue or expense to a date after the cash is received or paid. And the 2 types of deferrals are deferred expenses and deferred revenues. The other 2 types of adjustments are accruals. And accruals are when you record an expense before the cash is paid, or you record revenue before the cash is received. So the 2 types of accruals would be accrued expenses or accrued revenues. The first adjusting journal entry that we will look at is deferred expenses. The name I prefer for these is prepaid expenses. You can use either one of those terms for these. And 3 examples of these adjustments would be prepaid rent, office supplies, or depreciation. We'll look first at prepaid rent. And the journal entry that you see on this slide is what we call the initial entry. It's not the adjusting journal entry yet. So in this example, they say that Smart Touch Learning prepaid 3 months of office rent of $3,000, $1,000 per month for times 3 months on December 1st, 2018. So at the time they prepaid the rent, the journal entry was that they debited prepaid rent, which is an asset account on the balance sheet, for $3,000. They credited cash for $3,000. Now we get to December 31st, and we realize that $1,000 of that prepaid rent has now been used up. So here's what our adjusting journal entry will look like on December 31st. We will debit rent expense to move $1,000 of it onto the income statement as an expense, and we will credit prepaid rent to move $1,000 off of the balance sheet where it was in an asset account. Okay, next we'll look at an example of office supplies. And in this chapter, whenever you have a problem that involves office supplies, the dollar amount that you're going to journalize is not the dollar amount that they give to you in the problem. Instead, you have to compute a dollar amount that you're going to use in your adjusting journal entry. So here they tell you that on November 3rd, the company purchased $500 of office supplies on account. As of December 31st, when they take account of their office supplies that remain on hand, they find that $100 remain on hand. So therefore, if you look at a T account for office supplies, we see that the balance as of December 31st is $100. We had a debit to that account when they purchased office supplies on November 3rd of $500. So the amount that we want to journalize is actually the amount of office supplies that are used up during the period. So it's going to be a credit entry over here. So can somebody tell me, well, you don't, it's not a big surprise, they show how to compute it down here, but you would determine that the credit entry that you have to put there for the amount of office supplies used up would actually be $400. So then looking at our adjusting journal entry on December 31st, we would debit debit supplies expense, $400. We would credit office supplies, which is an asset account on the balance sheet, for $400. Okay, next we'll look at depreciation, which is a special case of a prepaid expense. And we're actually going to have a chapter in the book, chapter 9, where we deal much more in depth with the subject of depreciation, but we're just going to get a brief introduction to depreciation in this chapter. So depreciation applies whenever you have what we call property, plant, and equipment. There are other names for property, plant, and equipment. You can also call it plant assets, or you can call it fixed assets. And what we're talking about is long-lived, tangible assets that are used in the operations of a business. So examples of this would be land or buildings or equipment, or it could be vehicles or furniture, something like that. Now, land is different than any other type of plant asset because land is the one plant asset that you do not take depreciation expense on. The theory behind that is that land does not get used up. Land never really declines in value, so there's no reason to take depreciation expense on land. But if it's any other plant asset other than land, then you do take depreciation expense on it. And what you're doing by taking depreciation expense is you're allocating the cost of the plant asset over its useful life, over the period of time that you estimate that it will be used. So if you purchase a building and you think the useful life of that building will be 50 years, you don't show the entire cost of the expense, the entire cost of the building as being an expense in year one, because that would be misleading. It would make it look like you had a huge loss on your income statement for the first year. What makes a lot more sense is to put 1/50th of the cost of the building on your income statement as an expense in each of the 50 years that you'll be using the building. So you're allocating the cost of that plant asset over its expected useful life. There are quite a few different methods that can be used for depreciation, but in chapter 3, we're only going to use one of those methods, which is really the simplest method. And that method is called the straight line depreciation method. And the formula for that method, which is shown near the bottom of this slide, is that we take the cost of the asset minus its residual value, and then divide by the useful life, which will usually be some number of years. Now, residual value means what we expect that we can sell the asset for at the end of its useful life. However, in chapter 3, with most of the problems you'll get in my lab, they'll tell you that there's zero residual value. So if that's the case, then it's pretty simple. All you have to do is take the cost of the asset divided by its useful life measured in years. Once we get to chapter 9, then more of the problems that you work with are going to have some other figure that they'll use for the residual value of the asset. So here's an example. It says Smart Touch Learning received a contribution of furniture with a market value of $18,000 from Sheena Bright in exchange for shares of stock. So we will debit the furniture account, $18,000. We credit common stock, $18,000. And again, this is the initial journal entry. It's not the adjusting journal entry yet. Okay, then we get to December 31st, and we have to make our adjusting journal entry. So first of all, we have to calculate how much depreciation expense we're going to have to take. So we take the $18,000 cost divided by the useful life, which we estimate to be 5 years. You can make, with GAAP accounting, you can make whatever estimate you think is reasonable of the useful life of the asset. So 18,000 divided by 5 years gives us annual depreciation of $3,600. And so far here, we've only owned the furniture for 1 month. So then we have to divide the $3,600 by 12 months to get a monthly amount of $300. So then for our journal entry, we're going to debit depreciation expense dash furniture, $300. And the other side of this journal entry is always going to say accumulated depreciation furniture. That's a credit for $300. Now, that account called accumulated depreciation is also, that's going to be a balance sheet account, unlike depreciation expense, which is an income statement account. And accumulated depreciation is what we call a contra asset account. A contra account has two main characteristics. First of all, it's paired with and listed immediately after a related account, and it's associated with that other account in the financial statements. And its normal balance is the opposite of the normal balance of the related account. The book value of a depreciable asset is the cost of that asset minus its accumulated depreciation. If we were to look at the balance sheet now of Smart Touch Learning, where they show the furniture, it would say furniture, $18,000, which is the cost of the furniture. Then it would say less accumulated depreciation furniture, $300. And then it would say, sometimes this line isn't really labeled, but the figure would still be there. Book value of furniture, $17,700. Now, when we get to January 31st, at that point in time, they will have owned the furniture for 2 months. So on that date, then it's going to say less accumulated depreciation furniture, $600, and it will say book value of furniture, $17,400. So we keep accumulating in that account called accumulated depreciation, how much depreciation expense we've taken on the furniture so far. Okay, the second category of adjusting journal entries is deferred revenues. So this is when a company receives cash before it does the work or delivers a product. And I think I mentioned this very briefly last week, but this account, it can also be called unearned revenue, but it's a liability because if the company never provides the service or delivers the product, it's going to have to refund the cash to the customer. If it does eventually provide the service or deliver the product, then it's going to be converted from unearned revenue on the balance sheet to earned revenue on the income statement. So here's our initial journal entry. It says on December 21st, a law firm engages Smart Touch Learning to provide e-learning services for the next 30 days, paying $600 in advance. So they cannot recognize this as revenue yet because it is not earned. They have not provided the services yet. So the journal entry here is they debit cash, they credit the liability account called unearned revenue for the $600. Now when we get to the end of the accounting period on December 31st, they determine that they have provided a third of the services during the last 10 days. So they can convert that third of it from liability to actual revenue on the income statement. So the way they do that is they debit unearned revenue, $200 to take it off of their balance sheet, and they credit service revenue, $200, to put it onto their income statement as revenue that they have earned. Okay, next category is accrued expenses. So these are expenses that have been incurred, but they have not been paid for in cash yet. So some typical examples of accrued expenses would be salary expense, interest expense, or utilities expense. Okay, looking at salaries expense, Smart Touch Learning pays its employee a monthly salary of $2,400, half on the 15th of the month and half on the first day of the next month. So for the half on the 15th of the month, that's very straightforward. We just debit salaries expense, $1,200, we credit cash, $1,200. Now, the other part of it is a little more involved. So on December 31st, we haven't actually paid out the other half of the month's salary expense yet. That's going to happen on January 1st. But to prepare our financial statements for the end of the month, we have to accrue for that salaries expense that we have incurred. Therefore, the adjusting journal entry is going to be to debit salaries expense, $1,200, credit salaries payable, $1,200, to put it onto our balance sheet as a liability. Then on January 1st, when we actually pay out the payroll, we'll remove that salaries payable from our balance sheet by debiting salaries payable, $1,200, and we will credit cash, $1,200, as we actually pay out the payroll to the employees. Okay, then accrued interest expense. On December 1st, Smart Touch Learning purchased a $60,000 building in exchange for a one-year loan. So in other words, they financed entirely the purchase of the building. There was not any cash involved in it. So on the date that they purchased the building, they would debit building, $60,000. They would credit notes payable, $60,000. That's a liability that will go on the balance sheet. Okay, whenever we have to compute the amount of interest that has been incurred, here's the formula that we'll use to do it. We take the principal amount of the loan or the debt times the interest rate times the amount of time that's gone by. So here, the principal amount of the loan or the note is $60,000. The interest rate is 2%, and that interest rate is always expressed as an annual amount. So here, when only 1 month has gone by, between December 1st and December 31st, we have to take it times 1/12 to express it as a monthly amount instead of an annual amount. Therefore, for the month of December, the amount of interest that we have incurred would be $100. So now for our adjusting journal entry for December 31st, to recognize the interest expense we've incurred, we would debit interest expense $100. We would credit interest payable $100. Okay, then finally the fourth category of adjusting journal entries would be accrued revenues. So this is when a company performs a service but has not collected the cash yet, or they deliver a product and have not collected the cash yet. So here it says Smart Touch Learning is hired on December 15th to perform e-learning services beginning on December 16th. The business will earn $1,600 monthly and receive payment on January 15th. As of December 31st, $800 is earned. Now, we've said that in a lot of cases, a business will invoice their client immediately, but here we're assuming that so far as of December 31st, there hasn't been any invoice issued. Therefore, nothing has been put into accounts receivable. Therefore, as of December 31st, being the end of an accounting period, we do have to make some kind of adjusting entry to show this both as revenue and as accounts receivable. So notice that our adjusting journal entry here is not for $1,600 because only half of the services that are being provided fall within the month of December. The other half of them will fall within the month of January, which we're not concerned about yet. We're only preparing our books here for the month of December. So we will debit the accounts receivable for $800. We will credit the account service revenue for $800. Okay, then on January 15th, they received the payment from the customer for the entire month worth of services, which would be for $1,600. So we know that we would have to debit cash for $1,600. Now there are two different accounts here that we have to credit. We credit service revenue for $800, but that's only for the revenue that falls within January because we already booked the revenue that falls within December back in the previous journal entry that we made on December 31st. And then the second account that we will credit is accounts receivable. Back on December 31st, we debited accounts receivable to put it on our balance sheet, $800. Now we're taking that $800 off of our balance sheet because the accounts receivable is being paid off. Okay, here's an exhibit from the book, which is a good summary of what the different adjusting journal entries look like. And notice that it's only when you're doing a deferral that you have an original entry in addition to an adjusting entry. If it's an accrual, there is no original entry. There's only an adjusting journal entry. And then down near the bottom, the authors give you 2 rules of thumb to remember about adjusting journal entries. The first one is that adjusting journal entries never involve the cash account. The second rule, I would state differently than the way the authors state it. The second rule that I would give you is that in the adjusting journal entry, one of the 2 accounts is always an income statement account, either revenue or expenses, and the other account is always a balance sheet account, either an asset account or a liability account. Okay, here's a list of all of the adjusting journal entries that we made. And this looks like something you might actually see in practice if you're working in financial accounting. Often it is the CPA firm that works with your company that decides, particularly at the end of the year, what adjusting journal entries need to be made to put your books on an accrual basis. And so they will give you something that looks like this, and then you will, working in the company, you will actually make these journal entries in QuickBooks or in whatever accounting software it is that you're using to put your books on an accrual basis. And notice that the journal entries will usually be lettered like this. There's a letter next to each one, so A, B, C, D, E, etc. And then there's a key up at the top where it tells you why each one of these adjusting journal entries is being made. So for example, for A, it says the reason they're doing that is that prepaid rent expired for $1,000. So this is very typical of something that you see in real life, and as I say, very often the CPA firm will give this to you if you're working in a company environment doing financial accounting. Okay, now when we have finished doing our adjusting journal entries at the end of the accounting period, we prepare another trial balance. And this trial balance, we're going to call the adjusted trial balance. And it has much the same purpose as the unadjusted trial balance. We want to make sure that when we did our adjusting journal entries, that we didn't do anything that would have thrown the accounting equation out of balance. And so here's our adjusted trial balance after we've made all of our adjusting journal entries. And at the bottom of it, you can see that the debit column has the same total as the credit column. So by preparing this, we've proven that in fact our accounting equation is still in balance.
Excuse me.
Yeah.
So the first we do unadjusted trail balance.
What? I didn't hear the whole question.
The first we doing unadjusted
Mhm.
trail balance.
Yes,
Unadjusted trail balance.
we did unadjusted trial balance in chapter 2. You do,
Okay.
yeah, you do that first. Then you do the adjusting journal entries. Then you have to prepare another trial balance, and you call that the adjusted trial balance.
Okay.
So you use the unadjusted trial balance to see what adjustments have to be made. And then after you've made those adjustments, you want to make sure that you're still in balance. So that's why you prepare another trial balance and you call it the adjusted trial balance. Okay, and last week we made it sound like you prepare the financial statements from that trial balance, the unadjusted trial balance, but that's not really true. It's really this trial balance, the adjusted trial balance, that you will prepare the financial statements from, because you want your financial statements to be on an accrual basis, and it's this trial balance that gets you onto an accrual basis. Okay, another thing that in practice you do see a lot in financial accounting is a worksheet. And a worksheet is often prepared in Excel. So this looks a lot like Excel if you look at this example of a worksheet. Oops, that's my phone, forgot to turn it off. On a worksheet, the first column, column A, we list all of the account names that we use. And then columns B and C are where we show the figures for our unadjusted trial balance with both a debit column and a credit column. And then the next couple columns after that are where we show our adjustments as we would show in adjusting journal entries. And again, we use the letters to refer to what each one of those represents in terms of an adjusting journal entry. And then columns after that are for the adjusted trial balance. And so you can come up with the numbers for the adjusted trial balance by either adding or subtracting across. So if you were to look, for example, at the line for accounts receivable, it had an unadjusted debit balance of $1,000. An adjustment was made to it of a debit of $800. Therefore, on the adjusted trial balance, it's going to have a debit balance of $1,800. So this shows everything that you would see on your trial balances as well as your adjusting journal entries. One of the problems that you'll be doing on your homework, you will be filling in the data for the adjusting journal entries in this format on a worksheet. And you'll be labeling them A, B, C, D, etc. So just follow this example. It's really not that difficult. And then likewise, you'll be adding and subtracting across to come up with the appropriate numbers that will go on the adjusted trial balance. Notice here there are also columns that are not filled in for the income statement and the balance sheet. That part of the worksheet we're going to go through next week when we get to chapter 4. Now, most companies that use accounting software, you're going to assume don't need to use Excel worksheets. Actually, the larger, more complicated companies do, because if you have, for example, foreign subsidiaries, and all of those subsidiaries have to be consolidated into one larger entities, the accounting software packages don't work very well to do that. So the very large companies, say Walmart, actually does use Excel spreadsheets to consolidate all of their entities into one. And if you were to take an advanced financial accounting course at the graduate level, that's one thing they focus on there, is how you do how you use worksheets to consolidate entities into one large consolidated entity. So worksheets really, even though we use a lot of accounting software, worksheets really are used quite a bit in practice in larger organizations. Yeah.
For the adjustments, will the totals always be the same?
Well, one thing that's odd, I'm not sure if I'm answering your question or not. If you take this column and add this to it, it doesn't add up to this. If you add down, everything adds correctly, and your debit column has to equal your credit column. But you can't add these totals across. They don't add up. It's just the way the rules of debits and credits work. But I don't know if that answers your question or not.
Kind of.
Okay. Okay, why don't we take a 10-minute break before we do the problems together?